A very good morning and welcome to this conversation on how capital moves in a market correction. My name is Nzinga Qunta and I'm so pleased to be in conversation with Mathieu Chabran, who's the co-founder of Tikehau, and Roxana Mohammadian-Molina, who's the CEO of Blend Network. Thanks both so much for your time. I'm going to ask both of you the same question to start off with. Mathieu, I'll start with you. How do investments behave during a market correction? And is there anything investors can do to prepare for such times?
Yes, thank you, and good morning. Thanks for having us, and thanks to the FII for this great organization. If you allow me, maybe to step back a little bit, because we come out of a pretty unique situation, decade, I would say, starting maybe with the GFC, the global financial crisis, that obviously was increased by the pandemic. And what has happened over this period, and I think it's important to step back to understand, what might be happening now, is this extremely accommodating monetary policy that has been driven the whole asset spectrum, the whole asset pricing. And at school, remember we learned the invisible hand of the market, and that there was an invisible hand of the market that was setting asset prices. And then that was Adam Smith. And then, the central banks stepped in and they created what I like to call the very visible hand of the market. Because as David Solomon pointed out earlier on this week, very rightly, fixed income market had been nationalized. And effectively, there was no longer a supply-demand balance to set the price of the fixed income, the interest rate, which in turn has been driven the whole credit market, the whole credit spectrum, and has driven investors to buy bonds, corporate bonds at negative interest rates. No back trading, but if we step back today in October 22, coming back, we could say, what were we doing back then, buying some negative sovereign debt, buying some negative corporate credit, and in turns, obviously, because if you come back to the theory, the corporate finance valuation, if the price of an asset is the future cash flow of this asset discounted at a risk-free rate plus a risk premium, when the risk-free rate goes up and the risk premium increases, obviously, the price of the asset goes down. So we are now, we've entered into this new cycle. I don't think it's a new normal. I think it's the normal, where interest rates basically are driven, the cost of liquidity. And today, your Euribor is in Europe, at 3%, 4% in the US, even here in the Kingdom, we're seeing this morning, 6%. So that's the cost of liquidity. And then you had effectively the value of credit. And so the value of credit, the credit spreads have widened and are driving, the whole asset prices down. So it's actually, I think, a healthy environment for investors to be allocating capital, because now they have the conditions and all the metrics to be doing the work very rationally.
Okay. Roxana, I would ask you the same question.
Thank you so much, Nzinga, and great to be here this morning. Thanks to FII. The title of the panel is How Capital Moves in a Market Correction, but I kind of wish that what we are facing right now, what is about to hit us, was just a market correction. I don't think it's just a market correction. I think that what we are facing is really a new world, is a brave new world in many aspects. It is obviously the end of cheap money, as we have been hearing, and it is we are exiting the investment phase that we had seen since the global financial crisis. But I think it is a lot more than that. It is the end of an era, because we are really seeing an overhaul of many of the ways that we live, we work, we interact, we communicate, and also we invest. We are seeing a whole new generation of young people that they have a completely set of different expectations that we had or that our parents' generation has. So I think, yes, what Mathieu mentioned, and of course what we have been hearing a lot, the end of this, the interest rate cycle and so on. But really, I think there's a lot more aspects, and it's a brave new world that we are seeing, the end of an era and the end of the many things that we knew how they work. And in that sense, I think it's also important that the way to analyze it going forward is, in the past we used to look at historical data, do our statistical and econometric analysis and say, well, this is how assets and capital and investments reacted in previous cycles. And so based on the data, this is how they are likely to behave now. But I think that because we are completely on a different new world, the parameters are different, so it is also risky to kind of use the same tools and historical data and analysis and regression and so on to draw conclusions about how markets and capital and investments will behave in the current cycle, because the parameters are just completely different. Those relationships, they no longer stand. I mean, my background is quantitative economy, so my first job was actually building econometric models for commodity prices, feed it historical data, produce those parameters, sensitivity parameters, and try to forecast the price of copper, aluminum, and so on. But I think that type of analysis is now very difficult to do anymore in this new world. So how does capital move? I think is as maybe simplistic or old-fashioned as it might sound, is just really stepping back and taking the big picture and looking at the big picture and the bird's eye view of what is this new world, what are these new relationships, what are this new society, and so on.
Mm-hmm. Mathieu, as an alternative asset management and investment specialist, what investments are you seeing have the most activity?
Yeah, so coming back to my introduction, for 10 years, when money has no value, if you allow me, investment has no merits. And so people were effectively playing a lot of options. That's where we saw the development, obviously in the tech world, in the alternative asset class, or digital class, I should say, like cryptos. And all of a sudden, when, coming back to my point, money has some value and you have to price the assets of interest rates, all of a sudden what we are seeing, what I am experiencing, is that people are looking for high recurring coupon, downside protected type of assets, because there is a cost of capital, of liquidity, 3, 4, 5%. Where are the interest rate, going? I don't know, but certainly probably more up than down in the short term. And so they want the premium on this risk-free rate, let's say. And so we moved, from maybe what was an environment where people being a little bit greedy wanted to do, a 10x in 1 year. I'm making an investment. Next year there is a new round of funding. I'm going to be making, a massive valuation. To an environment where they say, you know what, give me 10% for the next 10 years, and I can compound effectively my investment. Mm-hmm. And I think here again, I think it's healthy. So we're seeing this type of shift of capital, very strong tailwinds for the private strategies, for the private markets, private credit being one of those. And obviously private credit cannot stand in isolation. They're being priced off the public market. And so we're seeing, the yield, the returns on those strategies, going up. And again, it's compounding. You have less volatility. That if you've done your work right in underwriting a credit, in underwriting a real asset, a real estate, a tenant paying a rent, you're creating this compounding effect. If on top of that you can create some floating rate type of instruments, you're mitigating the interest rate risks, which obviously can be, when it comes to fixed income type of investment, the most significant risks. And so I'm expecting more and more of this asset class, to pick up. That's happening at a time where, right here, right now, although not here in the kingdom, but in many places the capital markets are shut down or actually not properly functioning. The bank market is also a little bit under pressure because of regulation, because of cost of funding. But yet an economy, a real economy, needs some funding. Capital, debt, bespoke financing. And that's where we're seeing a lot of flows. Investors are increasing their allocation to these private assets. And whatever gets you, once again, this compounding effect on your portfolio, if you're a family office, if you're a long-term liability like an insurance company, like a pension fund, and even more so if you're a sovereign fund, that's where you can effectively build and construct your portfolio.
Okay. Roxana, what industries are seeing the most volatility? Why is that, and what can be done to cushion or protect against that?
Yes, I mean, I can basically focus more on the tech and fintech side. That is basically where my area of expertise. And I think that we are seeing really interesting strategic opportunities in fintech, but there's also the correction that has already started and that we are likely to continue to see that will, I think, will be very welcome from 3 points of view. First of all, in leveling the playing field, for companies that I can talk about more, the valuations and also the flow of talent into tech companies that we have seen in the past few years. In terms of the leveling the playing field, I think the situation that we have seen over the past few years, this easy money for people with any kind of tech idea, fintech idea, is really kind of unsustainable. People, with tech ideas being able to raise on the base of an idea. I personally know people who had an idea and being able to raise 10, 20 million for an idea, and investors and VCs just throwing money at people. I think this is clearly unsustainable, and it really because effectively you are rewarding those people for high-flying ideas that are untested and frankly some questionable decisions as well. And so this correction would be welcome in that sense that many companies, competitive companies, or companies that they struggled in that environment where you had so much money throwing at these new startups and so on. On the valuation side as well, again, I think the unsustainable of the valuations that we have seen. I mean, some of those companies that I don't want to name are great, but are they really worth 10, 20, 30 billion for companies that are not really even profit making? I think for me personally, coming from an investment banking background, I always kind of have struggled to understand this valuation for not profit making, and for the CEOs kind of proudly saying, well, we are not expected to make any profit for the next 5 years. And people that sometimes we speak to, where they would say, well, VCs, we wouldn't invest in a company that is profit making because that means that maybe they are not growing fast enough. So that is something that I personally kind of never understood, and I think that this valuation, we are going to see coming back more in line. And then the third point on the talent, that we have seen so much talent going to the techs and startups and so on, with legacy companies that had good strong fundamentals, but continuously struggled to attract this new generation of tech talent, and losing tech talent and unable to attract tech talent. I think that we also the correction, we are also going to see the reverse of that trend, with those traditional companies that are going through a digital transformation now being able to hire more the talent that they need.
Okay. I'd like to stay with you and talk about how the current market environment supports real estate. And Mathieu, I'm going to ask you to answer the same question as well after Roxana has done it.
So I can talk a little bit more on that from our point of view of our company, which is effectively a digital lending platform for SME property developers and mid-sized property developers. So we provide debt to property developers, and basically being backed by family offices and institutional investors. So I think that this market, prior to 2008, it was the development finance market, was a market that was served by banks, traditional banks, your high street banks. But then that stopped during the global financial crisis. And after that, you saw the emergence of, the alternative lenders, the challenger banks. But effectively, they continued to be banks. So they had very tight criteria in terms of their loan to GDP and their loan to values. And so alternative lenders, our company effectively provides the debt, just higher loan to value, higher gearing, and taking more risk and providing more, charging higher for that. I think in the current market, there continues to be really interesting opportunities. Of course, the exit for the development finance is the key part that we need to focus on, the key part that will be key, whether it is to sell in the current environment or to refinance. But yes, I think that it is an interesting market.
Mathieu?
Yeah, we tend to focus on mid-cap companies across Europe, the US more and more, and so the portfolio is really and the portfolio performance, the investment performance, is really driven by two things. First of all, which seems obvious, but that's when the winds are changing. You you can realize it's the management team. You know, it's effectively the management team who've been prepared, who've been anticipating. You know, you need to be a little bit paranoid, you know, sometimes. And when, you know, what we've been experiencing hit us, you can see the difference between the people who've been only navigating a very complacent environment, you know, for 10, 15 years, once again, when it comes to financial conditions, and the one maybe a little bit more anticipating any kind of downturns and being prepared for this type of situation in some part of the world. So that's, you know, the management team. It's an intangible asset, but it's certainly, you know, the most precious assets when it comes to investing. And then, you know, the companies themselves, right? So without being too specific on the sectors, what we're seeing right now is that all the mega trends, obviously, energy transition is one, cybersecurity is one. We see, you know, some big themes like that where, you know, the growth is here regardless. It's here regardless, and the capital going there, going back to your first question, it's no longer a financial play, it's a strategic vision. I would add, by the way, you know, to elaborate on our question, and don't want to digress too much, but more and more investors are looking for purpose. They're looking, you know, for impact. And I want to open, you know, the wider ESG discussion. There was a great panel earlier on, but I've been doing this for 17 years at Tikehau, and over the years we've been pushing, you know, this. I mean, you guys should look at that. And now we're seeing it's totally the reverse. If you're not effectively impactful in the asset allocation, the investment you make, in the companies you finance, in the companies you invest into, then you're being discriminating as, you know, as a manager, you know, in the allocation. And that's probably the best news, you know, you can think of, because as they were saying earlier, it's no longer a political debate. It has to be embedded anywhere in your investment analysis, in your underwriting, underwriting standards. So the performance of the portfolio, how is that effectively performing in this cycle, really depends on these two aspects. And we as manager, we're also being very discriminating in the way where we add more capital when needed. Is it a short-term liquidity need, or is there effectively a massive shift in the industry, and then the company itself has to reposition, and you could put as much capital as you want, you know, anyway, you know, the company would go sideways. And it's a very healthy, you know, dialogue you have with the management team, you know, and the corporate executives.
Roxana, let me come back to a point that you were making a little bit earlier on in terms of how the economic modeling perhaps that you used to do when you started working may not be enough anymore to predict what's coming in this new world that you've spoken about, and in the new global order. What does an investor and what do companies have to do in order to be fully aware of what's coming and in order to protect themselves as well?
By the way, I just really wanted to agree with Matthew's point on the fact that, you know, now the demand for ESG and sustainability and has really shifted. It's no longer, you know, from the company itself, it's from the clients, it's from the investors that, you know, that needs to be embedded in your investment strategies. But yes, I mean, in terms of, as I said, the dangers of looking at those, because, you know, you hear all the time, like, this is how markets have reacted in previous interest rate cycles, and this is what they should react in the current cycles. And there's dangers with that, is that really we are in a completely new world where those relationships no longer stand. So I think it's more really about looking at the macro trends, you know, looking at the society trends, looking at the changes in the ways that we work and we live, and the work-life balances, and how that has the implications in terms of, like, just talking about the real estate market, the you know, co-living, for example, or the student accommodation market, and so on. So it's just kind of those big trends that I think right now more important than just really going back to the historical data and trying to take the conclusions from those sort of things. I mean, co-living is a big theme that has been kind of around for maybe 10 years, but now really taking momentum on the back of the trends that we are seeing, and the new people, you know, the cost of living crisis all over the world, and people not delaying their buying houses and wanting to live in communities. So all those are themes that I think that you can see just by taking a step back and looking at just the big bird's eye view of what is happening right now.
Let's follow up on that. that point and divert a little bit from the discussion before we go back to that. I'd like to pose this question to both of you. What's the importance then of diversity when it comes to investment teams and that big picture thinking that you're talking about in order to, and how, if in any way, will that cushion investors and investments when you're thinking of new ways, the actual team and the diversity that's there?
Well, I think it's kind of a little bit similar to the question of sustainability and ESG and so on. Is really something that now no longer it really comes even from the inside the companies. The demands come from the clients and the investors to have that diversity of teams, because also you are serving as a company a diverse base of customers. So having that diversity in the company to be able to kind of respond to your customers' needs at every time. And I think this is something that we are seeing increasingly post-COVID as well. But I think the trend is similar to what we were mentioning about the sustainability and the ESG is coming increasingly. Not the push is coming not from the company, but from the customer, from the investors, and from the world around us.
Mathieu, do you agree with that?
Yeah, I mean, if I can give you a candid, feedback of my own experience. So I'm French. I was based in Paris, and I moved to the US, to New York 4 years ago. And at Tikehau, I thought that we were very early on this ESG topic, and that's why I don't want a broad brush to paint that, because I arrived in the US very proud, because at Tikehau, out of the 700 people, we've got 43% of women colleagues. Okay, and out of that, a third are part of the top management. And I also arrived very proud on the climate. As I was saying, we were early. And then I had my first meeting with public pension funds, in the US, because I moved there to effectively talk to these asset allocators. And that was no longer, the question on the table. Climate is picking up now, but at the time it was not on the table. And when it came to the S of ESG and the diversity, equity, and inclusion, that is now clearly, it's not a matter of putting in top of the list. It's, to Roxana's points, it has to embed the whole society. And so the work that, thanks to this exposure and move and experience we've been putting at the firm, is now extremely valuable. Bringing that back to the wider play field, that we are operating into, and to the point that it's no longer, an option. And worse than that, it should never be like a marketing tool, pushed forward. And if we all converge there, the asset allocators, the investors, the consultants, the asset manager, I think there will be a massive step forward in this industry.
Okay.
I think just wanted also to add on that point, because obviously we are in Saudi Arabia, and what the amazing things that we have been seeing and hearing. I think someone on one of the panels was mentioning the other day that, actually she's my colleague from Barclays time, that when she came to Saudi maybe 17 years ago and went to a ministry, there was not even a toilet for a woman. But nowadays, you see like the women in Saudi Arabia, they are everywhere in public life and at the highest levels of jobs in public and private sector. So I think this country as well has been doing a really amazing job in that sense, and that really the implications that has in terms of everything. So these women, they are earning money, they are saving money, they want to invest. For example, just mentioning one sector, the implications that this has in terms of fintech and wealth tech. Companies. These women, they want to invest their money, they want to invest their savings, and so wealth tech apps that allow you to invest in different sectors. So it just has a whole range of implications.
And then what can investors do to build resilience across all markets, coming back to how capital moves in a market correction? Both of you are going to have to answer.
Yeah, well, what can they do in their allocation, you mean, or
yes.
Yeah. Well, the good news is that we're no longer in the model of the fixed income equities. The 60-40 model that, once again, 20, 30 years ago was the only asset allocation possible, if I'm sketching a bit. There's been the emergence of many alternatives financing the real economy. Private equity, obviously, is one, but it's no longer private equity only as buyout, where we buy each other, the company one from another, putting a lot of leverage. Now it's about reinforcing equity base of privately held company. Again, mid-market companies, entrepreneurs-led, family-owned, who need to grow and need this equity base. It's about the private financing we were discussing earlier, when the capital market are dysfunctional, when the banking market is a little bit frothy, and yet you need some financing to the real economy. These alternatives are getting a lot of tailwinds. To Roxana's point, real estate, right? 3 years ago, one company I would not name here was supposed to become, a 100 billion market cap company because they were in the co-working space. And then all of a sudden, COVID, no one needs any office anymore. But then what happened, over the past few months, people, need this link because, the location creates, the link. And so you see that people come back. And the same way Roxane's point is great about co-living. It's no longer sitting at a desk and turning on, your computer, but it's the experience. So real estate is actually a great play. I'm not qualified to talk about the alternative digital, crypto and others, but you have a whole lot of investable assets that were not that widely spread, maybe in the previous cycle, that nowadays is fully embedded in an investor portfolio.
Okay.
On the building resilience, I really like to focus on kind of the more human side of it, because I think being humble and nimble for me is really the key. And I think actually, just as an anecdote, I really saw that reflected in a TV series regarding the company that Mathieu was mentioning, that really is about, not becoming greedy and being humble and nimble even when the music is playing, just yes, sometimes, you are under pressure to scale the business, but really, scaling in a responsible way. And I have seen in my experience, many CEOs that I would have thought, when they were building the business, oh, this guy is so conservative and going slowly and building slowly and going very slowly. But then when the music stops, those are the people that you think, oh, they are going to really do great just because they were conservative and because they were careful. So being humble and nimble, it pays off. And that is, I think, building resilience.
Okay. Venture capital firms across the world are said to be optimistic that investors, markets, and companies are able to react optimally to today's rapidly changing market environment. Would you say that's a correct characterization of what's happening now? And why?
Yeah, whilst I'm not an expert in this segment of the market, I 100% agree, because venture is backing entrepreneurs. That's the starting point of a venture, of an idea, of a project, and you need this capital to get the project off the ground. And there is no shortage of talent, entrepreneurs worldwide. And I think that the difference between 2022 and maybe when I started working 25 years ago is that the academic world, the society is now promoting entrepreneurs. It was maybe not the case 25 years ago. You looked good at a dinner if you had joined these banks or this consulting firm, and now being an entrepreneur is actually top of the perception, even for the young students. So venture, and obviously I won't go back to all these great success story that has been founded in a dorm, when they were students. So ironically, this part of the cycle, and Roxana, I agree 100%. It's you have to be careful when you join the party in the cycle. But right here, right now, is going to be a great cycle for young entrepreneurs with the backing of flexible capital.
And on that point, I think that what is important is also that the capital, is supporting those entrepreneurs, and obviously, for example, we are supporting SME property developers, but I think the same problem for SME entrepreneurs. Sometimes it's the lack of funding, the lack to access of funding. So I think those, for just focusing on fintech companies, the digital lending platforms that are being able to support entrepreneurs' ideas and so on, I think it would be, yes, a key part in the cycle.
Okay. And as we wrap up our discussion, what would your final words or thoughts on this issue be? Both of you.
I think that what we've experienced recently might be a wake-up call that capital remains a scarce resource, and we had forgotten about that, and that return on capital, but more importantly, return of capital, should drive any investment decision.
Yes, and I completely agree. And I think, directing capital to, as Mathieu was saying, impact is going to be increasingly more important. Directing capital to really projects and entrepreneurs that are doing something that is important. We have seen here during this race so many presentations about the importance of impact investments and impact investing in humanity. So I think that is going to increasingly drive decisions, but also just people just being really more careful about the entrepreneurs and the projects that they back compared to the past few years that it was just easy money.
Okay. Mathieu Chabran, who's the co-founder of Tikehau, and Roxana Mohammadian-Molina, who's the CEO of the Blend Network. Thanks so much for your time and insight on how capital moves in a market correction. That's where we leave it. Please, a round of applause for them as we end. Thank you.